Ich habe heute die Ehre, Julian Brigden bei mir begrüßen zu dürfen. Julian ist Co-Founder und Präsident bei MI2 Partners in Chicago. Sein Unternehmen verbreitet Makro-Research und berät unter anderem auch Hedgefonds. Also ein sehr spannender Gast, der auch auf Twitter sehr bekannt ist. Heute habe ich die Ehre, Julian bei mir begrüßen zu dürfen. Julian, how are you today?
I am pretty good, Lucas. And actually, I understood far more than I thought I would of your introduction. Those years that I spent in Reutlingen doing my Europäische Betriebswirtschaft have not gone totally to waste, even though it was, 30 plus years ago now.
That's crazy. Well, most of the times you can understand more than you can actually talk.
Exactly.
Right?
Exactly.
Cool, Julian. You are a micro analyst. Mm-hmm. You're my go-to guide for all questions regarding where we are in a macro cycle. And this is also why I would start with the following question. Many things are happening right now. Mm-hmm. If you look at returns for the year, basically everything is down. Commodities were quite stable till, well, about 4 weeks. Then they also were falling quite harsh, with the argument that maybe a recession is in front of the door. Julian, where are we in the current economic cycle, and where are we headed from now?
So we've been playing this growth inflation trade for pretty aggressively now for a while. The first report we wrote for clients in January of 2021 was inflation. This is the most important metric for 2021, and that proved to be the case. And we'd already started in November of 2020, and then adding to it in the spring to go short a lot of front-end curves in around the world. So we sold euro dollars, short sterling, and what now is called Sonias, right? And Euribor. And we played this very aggressively, flitting around the curve, because we thought that the inflation story was the driver, along with extraordinary strong growth, driven on the back of, particularly in the United States, this ridiculously large fiscal and monetary stimulus that was going to take a long time to filter through the system. Starting probably 4 weeks ago, we started to change our direction, and we actually bought some contracts last month in euro dollars and Sonias again, because not that we think that the inflation story is fully worked through, right? I still think there's going to be an awful lot of sticky pricing and possibly even some higher prints, Lucas, as we move into the end of the year. And in fact, we have a fiscal and monetary stimulus model that shows that we don't actually peak out core CPI here in the US until the end of Q3. And when I look at what's going on in Europe, I think it's a fantasy to believe that inflation has peaked in the Eurozone yet. I think it's entirely possible you could see mid-teens, low to mid-teens in Eurozone HICP. That said, the emphasis is now, I think, a little bit on where we are in the growth cycle, and there are definitively signs of pain starting to build. So that focuses my attention from a bond perspective into what is the typical price action that you see as you move into recession in the bond market. And no offense to the equity guys, but whenever I hear equity guys talk about the bond curve, I'm an old man now, so I'm allowed to scream at the TV like some delusional drunk. And the one thing that will guarantee that I will scream at the TV is when I hear equity guys say the curve inversion is a sign of the bond market pricing in a recession. That is definitively not a sign of the bond market pricing in a recession. In the bear steepener that we've had, in the bear flattener that we've had, that is the bond market pricing in rate hikes from the central banks into the front end of these curves, which means that 2-year yields push slightly higher than the long end of the curve. You can feel protected to own the long end of the curve because central banks are being hawkish. The signal for a real recessionary move is a bull steepener. So That's what happens where the bond market goes, ooh, so you've priced in 8 hikes. So you think you're actually going to get to 8 hikes, central banks. Well, I can tell because of what's going on in, let's say, the equity market or the real economy, you're never getting there. And so that's what we've started to play, that bull steepener. And predominantly, typically in that move, the long end doesn't really move that much. It doesn't sell off, but it doesn't rally. You can carry it. But it's the short end yields that typically drop as they start to kind of play that game. So I think we're in this transition, Lucas, from inflation dominance, dominating the story, to that recessionary narrative coming through. I don't believe we are yet in a recession. If you look at the PMIs, both of those PMIs were more commensurate in the US with what I would call a mid-cycle slowdown. So sort of 1.5% to 2% GDP growth, slightly more if I look at financial conditions. And that's still arguably at or above trend. I mean, Powell told us a few months ago that trend is 1.75. So I think it's arguable. I don't think we're in a recession yet. I think we can create the conditions for a recession later on. I think those have a lot to do with how this inventory cycle and employment cycle pans out. I can see significant risks rising that could cause us a very aggressive cycle on the inventory side, where we essentially go from inventory famine to feast to hangover in a matter of months. And in fact, I think we are moving, and this was actually our dominant trade for 2021 is inflation. It was in 2022. Inflation was the one in 2021. This one for 2022, we think, is the return to the boom bust cycle. So in other words, Lucas, we can go from literally everything looks great to things dropping off the face of the cliff almost instantly. And I think a lot has to do with the inventory cycle.
Great insights. Well, let me ask you a more aggressive question. We're already talking about inflation, and I guess one could say that the Fed is actually pretty hawkish, especially compared with the ECB. If you look at the Fed funds rate, which you can look at futures price, and you look at the forward curve, what you can actually see is that the market prices in more rate hikes until the beginning of 2023, around I guess March or April. And after that, the market actually expects the Fed to cut rates again. It's astonishing, right? Because we are still in a very inflationary environment. We can't see the peak yet. So do you think this is actually a case?
I think it's a logical look. I think given what happened in equities, I think it's a logical assumption. I mean, I'm a big believer in what I call hyper-financialization. So in other words, this feedback loop that exists between the real economy and the financial markets. So we wrote a piece recently for clients where we called the chicken and the egg. So I don't know if that analogy holds in Germany, I can't remember in German, but basically if you think about it like this, logic would dictate that when you look at the relationship between markets and the real economy, the real economy is the chicken, right? It's the chicken that sets the conditions for laying the egg. In economic terms, it's the real economy that sets growth trends, it sets inflation trends, it sets employment trends, it sets profit trends, right? And then the egg should be the financial market. So you create the conditions in the chicken, it lays the egg, okay? Actually, unfortunately, that isn't the case. So if you go and look at things like PMIs, which tend to be some of the leading indicators that we have in any economic leading indicators that we have access to, typically leading some of the more slower moving things like industrial production or inflation by 2 to 3 months, they actually lag the rate of change in the equity market in the US. So it literally is the egg that lays the chicken, right? And the problem is that as soon as you start to pressurize that equity market, and the reaction function is very simple. CEOs aren't paid to produce anything anymore, Lucas. They are literally paid to be shepherds of an equity price. That is their job. right? That's what they're paid for. I mean, up until recently, they didn't even have to make a damn profit, right? They, you know, in fact, making a profit was bad because it meant that you weren't growing as fast as you could. So literally what happens is that as soon as equity prices start to come under pressure, CEOs run off to their cupboard and they come out with their cost-cutting axe, and they start to look to cut capex and lay people off. And that's how this spills. The reaction function connects you through the equity market to the real economy. And so you push this equity market down far enough, and it hasn't gone down there yet, but you drop this thing 30%, which is kind of what I think is a realistic target, you are guaranteed a recession. In fact, since I think 1929, there's only one occasion where a 30% correction in the equity market has not resulted in a recession, and that was 1987, which, for those of you younger members listening, was not really a bear market. It was more of a negative gamma flash crash caused by portfolio insurance. But you drop this equity market 30%, you will have a recession. So to go back to your question, I think it's realistic for the bond market to then, in that sort of situation, go, look, if equities are selling off, I know that we're never going to get to that terminal rate that was priced before. And if we do go into recession at some point, albeit it will be at a much lower point than we've seen post the GFC, the Fed will buckle, right? Because this is all a game, when you're playing things like EDs, this is all a game of just probabilities and assumed reaction function.
Mm-hmm. Yeah. So what do you think? Currently, we don't see too many upside days on the market. Talking about equities, of course. Do you think every rally is now not the case to buy the dip? I mean, like if you look at the liquidity cycle, this worked pretty good to buy the dip from basically the COVID crash till
well, since 08, mate. I mean, literally since 08, you always bought the dip.
The QE era, basically, right? But this turned around since the liquidity started to drop back in December 2021. Mm-hmm. And if you look at the correlation chart, for example, of the S&P or Bitcoin with the net injections of the Fed into the market, it's basically the same chart. So what do you think, Julian, needs to happen in order for markets to bottom out? Is it that the Fed needs to pivot?
Yes, I think so. I really do. I mean, I look at equity markets, and I'm actually writing a piece now, and to my mind, there's just no way that we're at anything that's close to a capitulation. I mean, if you look at the value of the NYSE, so sort of the broad US equity market, right, with all the ADRs and all the listed companies, as opposed to just this very sort of concentrated, S&P or the NASDAQ. If you look at that against nominal GDP, which is, because it's in nominal terms, the equity market, we just hit the highest levels in 57 years. Back in the middle of last summer, we're down. The NYSE is down 16%. The average correction that we saw in periods like that was a 40% correction. Somewhere, and with the extremes like down 22 and down 60, right? So there was just no way that I look at this equity market and go like, what the correction that we've seen thus far, Lucas, is at all sustainable. I used to work for a policy consultancy think tank. A lot of my buddies are still in that space, which makes me a very lucky chap because I get all their research for free and I chat to them all the time. And these guys go off and talk to policymakers, and it's pretty obvious that the Fed has girded their loins and is prepared to be extremely tough. Right. And, there was a recent interview with Chris Waller, who's effectively acting as deputy chair within the FOMC and incredibly close to Jay Powell. And he was just saying, look, it's 2%. That's the target. And I don't care about the supply side. Congress didn't mandate me just to deal with demand push inflation. And so we're going to keep going. I mean, he was spinning we're classically optimistic that we can reset this labor market without, causing too much of a jump. But the sort of rise in unemployment that he was talking about guarantees you a recession. I mean, you've only got to see a 0.3 rise in unemployment and you're kind of done, because unemployment doesn't do this. right? If you go and look at a chart of unemployment, it doesn't do this. It goes up, it peaks sharply, then it drops, and it does these big rounded bottoms, and then it goes up. Unless they're prepared to come in and punt the cycle yet again, Lucas. And I think that's, I think that's delusional. I think the equity market is delusional. They're expecting some sort of equity version of immaculate conception, right? That we can somehow defeat the worst inflation that we've had since the 1970s and yet not have a nasty recession. It doesn't pass the smell test to me.